In a world where financial markets are as unpredictable as the weather, the Federal Reserve's decision to end quantitative tightening in December is sending ripples through the economic landscape. For those unfamiliar, quantitative tightening is the process by which a central bank reduces the amount of money circulating in the economy. This is the opposite of quantitative easing, where the central bank injects money into the economy to stimulate growth. The Fed's has been a significant factor in the financial ecosystem, influencing everything from stock prices to interest rates. Now, with its impending conclusion, the question on everyone's mind is, what does this mean for Bitcoin and the broader cryptocurrency market? Historically, the end of T has been a double-edged sword. On one hand, it signals a potential easing of monetary policy, which could lead to lower interest rates and increased liquidity in the market. This environment is typically favorable for riskier assets like cryptocurrencies. On the other hand, the transition from T to a more neutral or even accommodative stance can be fraught with volatility. The last time the Fed ended a T cycle, the markets experienced a significant correction. Bitcoin was not immune to the turmoil. In fact, during the previous cycle, Bitcoin's price mirrored the broader market's downturn. This historical precedent has many in the crypto community on edge. However, the current economic landscape is markedly different from the past. The global economy is still recovering from the pandemic-induced recession. Inflationary pressures are more pronounced than ever. This unique set of circumstances could lead to a different outcome this time around. Some analysts argue that the end of C could actually be a boon for Bitcoin. It may lead to a weaker dollar and increased demand for alternative stores of value. Bitcoin, often touted as digital gold, could see a surge in interest. Moreover, the cryptocurrency market has matured significantly since the last cycle. Increased institutional participation and a more robust infrastructure could provide a buffer against extreme volatility. Additionally, the rise of decentralized finance (DeFi) and non-fungible tokens (NFTs) has expanded the use cases for cryptocurrencies. Yet, despite these positive developments, the specter of a market correction looms large. The crypto market is notoriously volatile. Any shift in macroeconomic policy can trigger wild price swings. The end of T could lead to a short-term liquidity crunch. This could result in a temporary dip in Bitcoin's price, but it could also present a buying opportunity for those with a long-term perspective. As the December deadline approaches, all eyes will be on the Fed's next moves. Will Bitcoin mirror the massive price crash from the last cycle? Or will it defy expectations and chart a new course? The answer remains uncertain, but one thing is clear: the end of T is a pivotal moment for the cryptocurrency market. Its outcome could have far-reaching consequences for investors and the global economy alike. As we stand on the precipice of this potential financial upheaval, the stakes have never been higher. The world watches with bated breath to see how this chapter in economic history will unfold. In the end, whether Bitcoin will rise like a phoenix from the ashes of or succumb to the pressures of a shifting economic landscape is a question that only time will answer. But one thing is certain: the journey will be anything but dull. The lessons learned will shape the future of finance for years to come.